In the conversation now is Peter Schiff, CEO of Euro-Pacific Bank. Peter, we've seen quite a bit of action stateside today, this relating to the US dollar and those US retail numbers that came out showing just a little bit of strength. Do you think we are going to see a bit of action from the Fed next week on leverage and the timing of an interest rate hike?
Well, I don't think we're going to see any action. I think we get a lot of talk from the Fed, but there's very little action. As far as these retail sales numbers are concerned, if you X out autos, this is the weakest number of the year or since January. And the only reason autos are strong is because of all of the subprime lending in the auto sector that, like subprime mortgage lending, is going to come out to bite us. And the only reason I think consumers are spending more is because of inflation. You know, these numbers for retail sales do not take into account price increases. And while I don't believe that the official measures of inflation capture price increases, retail sales always captures the price increases because it measures the amount of money actually being spent, not what the government claims people are paying. So I think it's not people buying more stuff. I think it's people paying more money to buy less stuff. And it's not economic growth that we're showing, it's inflation.
The market has been speculating, Peter, that the phrase considerable time will be dropped from the Fed's reference on interest rates. So in your opinion then, given how, I guess, negative you've been about the retail sales numbers today, do you think that phrase won't be amended?
Well, they're not going to. I think the next significant move by the Fed is going to be to announce a new QE program that's probably larger than what we're doing in Europe or in Japan combined, because this fantasy about a U.S. recovery is not going to materialize. You know, first half GDP in the U.S. was 1%, and that's if you believe the government's inflation numbers, which I don't. I don't think the second half is going to be much better. It's going to be nowhere near what the analysts are forecasting. I think we're headed back to recession, even the way the government measures the numbers. And I think the Fed is going to be forced to admit once again that it's wrong, and it's going to surprise all the dollar bulls who believe that it's going to go up on the back of a tighter Fed when the Fed ends up being even easier than any other central bank on the planet.
But Peter, if you look at the official numbers in the second quarter, growth from April to June was 4.2%. I mean, this is higher than historical averages when we were clocking up about 3.4% pre-crisis.
Yeah, but you have to realize that that is only because a lot of the GDP growth that would have taken place in the first half, when we got minus 3.1, was pushed into the second half because economic activity that couldn't take place in the cold months of January and February happened in the spring. But when you smooth out those weather-related effects and you look at the entire 6-month period, you get 1% GDP growth. So you can't look at that 4% as indicative of anything. You have to average it in with the first quarter. And if you look at the numbers we're getting, look at the jobs numbers we just got, only 140,000 jobs created. The unemployment claims are now starting to tick up. We got a pretty bad number yesterday on the increase in unemployment claims. That's been trending up. So I think with the gains that we had, the 200,000 plus gains that we got for about 5 or 6 months in a row, that's over. And of course, those jobs were on net part-time jobs. These were low-paying jobs. Beneath the surface, we were still hemorrhaging quality, high-paying jobs. We just couldn't see the loss because they were camouflaged beneath the layer of temporary and part-time jobs.
But if you look at the structural change that has taken place in the employment market, some would say, well, you're not getting the same participation rates because older Americans are retiring and younger workers entering the system are saying, well, the jobs are simply not there. I'm going to go back to school and retrain so I can have the opportunities.
Yeah. You know, it's actually the opposite. It's the older people who are going back into the workforce because they can't afford to stay retired because of the escalating cost of living and the fact that they get 0% interest rates on their CDs. So it's the old people who should be retired who are coming back into the workforce, and younger people can't get decent jobs. And yes, some of them are wasting money by staying in school and getting worthless degrees and amassing a mountain of debt in the process, because a lot of our young people who are staying in school now, when they get out, they're still not going to have any jobs, but they're going to have a lot of debt that they wouldn't have incurred had they skipped college in the first place.
Just quickly, Peter, because we're out of time, the S&P, despite some of your comments today, is still tracking very close to the 2,000 handle. So where do we go from here?
Well, you know, the S&P, it's a tough call. I still think that the market trends higher, although we're going to have some pullbacks as bad economic news comes in. But, you know, bad news is good news for most traders because the only thing really supporting the market is the Fed. If the Federal Reserve actually followed through with its promise to stop QE and raise interest rates, the market's going to collapse, which is one of the reasons why I don't believe they're going to do it, because they're basing the recovery on the wealth effect of the stock market and the real estate market, and they can't undermine that phony wealth with rate hikes.
Appreciate the time today, Peter Schiff, CEO of Euro Pacific Bank.